questions, we'll jump right in unless anyone has any questions. All right, let's jump right into investments, which is mistake number 11, mismanaging your investments and investment risks. So this is page 5 in the purple section, or section 4.
So some of the first things you need to do for a successful retirement plan is to know yourself. What are your goals? What's your budget? What's your risk tolerance, especially? To develop a good retirement plan, you gotta write it down. We've already talked about that, and follow it closely. Your overall strategy will guide the investments you select. You wanna understand what's available to you, what kind of vehicles are out there. You wanna choose those investments to align to your goals. You don't wanna procrastinate either, you wanna start today. You guys are all doing that. You begin with that statement of financial position that we talked about last week. Cash flow statement. Couple things you want to consider. Does your investments need to grow, or just you need some income off of it, or maybe both? What are you doing to optimize tax strategies? Investing, that's very important. Tax drag is a big investment cost, bigger than any other cost out there are taxes that you'd have to pay. When are you going to need the funds? Are you going to need some next year? Are you going to need some 5 years from now, 10 years? How are you going to need to take it out? Shorter time horizons would be more like treasuries or CDs or money market accounts. Because you can't withstand the volatility of the stock market in the shorter term.
Time horizon is really important. That really should be the primary driver of how you should be investing, is time horizon before you need those dollars. Yes?
Okay, so like your 403Bs and 401,
Yeah.
457, they don't have those, like a lot of those short-term options.
Some don't, some do.
So,
They should have something available that's short term.
money markets, but like at 1% or very, very low
Yeah.
percentage.
But if it's money you're gonna use in the next 12 months, then it needs to be in the money
It
market.
does, because, look at what happened earlier this year. The stock market was down 11%, and if you needed the money in the last, let's say you needed it 3 weeks ago, then you were down 11%. So it needed to be there.
And also, if you have it there and maybe you just did want to make a little bit more money, and you're gonna need it in the short term, but can you take that out or withdraw it and maybe buy something?
Well, you have to pay taxes.
Tax deferred though, that's what I meant,
You could do that, you could do the IRA rollover, or 401k rollover, or in-service withdrawal that we talked about. So yeah, you could do that.
At the end of this section, we're gonna talk about bucket investing, and let's revisit your 401k and bucket investing. I think it'll answer some of your questions.
Okay.
Yes, sir.
Yes.
Up there says shorter term horizon. Earlier you mentioned 12 months. That's kind of offhand, I think. What would you consider like a short term?
24 months or less.
Okay,
Any money you're gonna use in the next 24 months should not
Should
be in
not
the
be
stock
in the
market.
okay.
And we're gonna actually go back to that too.
Okay.
We're gonna show you some really cool plans. You wanna consider, consider your future or your current investments. Take an inventory of what you have now. Some of the common mistakes you can do when investing is making decisions based on past track records, and that's a biggie. We're all probably the same age, or near the same age. If you remember the Janus funds back in the late 90s, early 2000s, and how they were doing so well, and the performance was like astronomical. And Janus was advertising that track record. The only problem was the guy that was managing those funds, Tom Marsica, wasn't there. The performance was based on his track record, and he wasn't there in the track record. So don't base your investment decisions on track records of investments. Don't make investments solely on yield as well. Warren Buffett, another big investor out there, you might have heard of him. He has a saying out there, more money has been lost chasing yield than any other investment out there. If it's too good to be true, it's too good to be true. So you gotta make sure you don't make those investment decisions based on yield alone. Improper diversification, putting all your eggs in one basket. We're gonna go over some things to maybe mitigate that, but, you know, ask the folks at Enron whether that was a good idea or not to put all your eggs in one basket. Making investment decisions based on TV or a friend or whatever. And generally, they're wrong, you know, volatility or craziness or bad news, whatever you want. It sells, and it sells advertisements. So you don't want to make investment decisions based on what you hear on the TV or a friend or whatever.
In simple terms, there's two ways of investing. You can loan your money to a company or a municipality
Or a bank.
or you can own an asset. And so we're going to talk about each one of these. First, loaning your money. So loaning your money to a bank is having a savings account or a CD. You're investing by loaning your money to a bank. You can go out and get a bond through a company or government. Again, you're giving money to, you're letting that company, that bank, that government borrow your money. In return, the borrower promises to repay you your principal investment at the end of the term, and they pay you interest in the meantime, right? So if you buy a CD, they pay you a stated interest. At the end of the term of the CD, you get your money back. So you're loaning your money to these institutions. Cash or liquid investments. This is your savings account, money markets, checking accounts, etc. You know, here we mentioned you should have 3 to 6 months of living expenses, but leading up to retirement, we're going to suggest that you increase that to 12 to 24 months of living expenses. And we're going to follow that up at the end of this section, specifically about how much cash you should have. But you do need cash available. You need that safety net, right? You need some money that's always safe and there. If the markets go down, you still have safe money that you can draw upon for emergencies or day-to-day living. Jay, you want to go into a bond?
Does anyone know what a bond is? It's basically, a bond is a loan to a corporation, a municipality, a government, a bank. You know, bonds have different ratings, different investment terms. Municipal bonds are tax-free, so if you loan your money or buy a bond from Royal Oak, for instance, the interest rate that they pay you is gonna be tax-free. So it's a great investment for people in higher tax brackets. Also, it's a bad investment in an IRA or a 401k. So you wanna make sure municipal bonds aren't in there. Bonds have different credit ratings or different risk levels. And the credit rating is what's the likelihood of that corporation paying you back. So AAA rating used to be the U.S. government. You know, that was the U.S. government could just print money and pay you back if they needed to. The government now is only AA rated at this point. They got downgraded a few years ago, if you remember. But corporations out there have ratings anywhere from junk bond status, single B, all the way up to just a few corporations out there. Berkshire Hathaway is one, and Pfizer is another that have AAA ratings, and everywhere in between. Bond prices can move with supply or demand. They can also move with the creditor rating. So if picking on General Motors, I seem to pick on it a lot. If their rating is downgraded, the value of the bond is going to go down because that the likelihood of GM paying back has actually gone down.
So if you buy a bond and you're agreeing to certain terms, You're saying that those terms can change?
No, they can't.
Oh, okay.
Now they,
But when you buy later and it's downrated, then they'll be?
Yep.
Okay, got it.
If you hold an individual bond to maturity and they're still in business, you're gonna get back all your money.
that's the key, you gotta be still in business.
Yes.
Yep.
If it goes down in value because it received a downgrade, you still get back all your money as long as you wait until maturity. The risk is if you need to sell it before it matures, and that's where you can lose some money.
Excuse me, one more question. Now, in your portfolios, someone was suggesting that, say for instance, if you do, that it's safer to have the money invested in bonds versus like use the stock market, so.
Generally speaking.
Generally speaking, but not necessarily so. And I'm gonna show you a chart that will show you different optimization levels of bonds versus stocks.
Jay mentioned earlier that, and this is all the way to page 19, because there's a lot of definitions in this section that we're not gonna spend time on. We wanna get to the concepts. If you're a higher income earner, municipal bonds in your non-retirement account probably make more sense than corporate bonds. And the reason for that is because the interest they pay is tax-free. So, for example, if you're in the 32% federal income tax bracket and you're getting a 4% municipal bond that's tax-free, that's similar to getting a 5.88% corporate bond or a 5.88% CD. So that you can see the higher your income bracket, the higher the after-tax yield is of a municipal bond. So the more money you earn, the more sense it makes to have municipal bonds as opposed to CDs or as opposed to corporate bonds inside your non-retirement account. Inside your 401k and IRA, this is not applicable. It would be outside of those retirement accounts. Okay. Questions on bonds?
When you mean non-retirement funds, you mean funds that we have that are post-tax? We've already paid tax on it?
Yes.
Okay.
So owning an asset, so that could be you can own stocks, you can own mutual funds, ETFs, real estate, gold, etc. So you're investing by owning a company or an asset. You own the gold, or you own a GM share, so you own part of GM. As an owner, you have no guarantees on your principal. If GM goes out of business, your share goes to zero, right? You're an owner of the company. There's no guarantee of principal. You're hoping for appreciation of the investment. You're hoping GM does well and your share of GM goes up in value. Potentially, you'll also get dividends or income from holding GM. So if they do well, they might pay you a quarterly dividend. So maybe you're investing for both reasons, growth and dividends.
So one of the ownership things out there are common stocks. Do we know what common stocks are? All right, it's the most basic form of ownership. Let me skip this page because everyone kind of knows what a stock is. Stocks are a great inflation hedge. So if Colgate Palmolive, the cost of the toothpaste goes up, they're gonna raise the price of toothpaste to you. So it's a great inflation hedge. Same with Procter & Gamble. If the cost of diapers goes up, then they're gonna pass on the cost of diapers to you. They're liquid. Stocks, most stocks can be sold on the stock exchange, either the over-the-counter exchange or the New York Stock Exchange. So you can sell them on any business day very quickly. There's no insurance on stock. If the company goes out of business or the stock market goes down or whatever, you can lose money in the stock market. Therefore, most people, most retirees seek professional money management. So professional investment management, somebody who can, help them along the way. There are a lot of advantages to having someone help you. You can be retired, is the number one advantage, instead of following your investments. But they have expertise. They're looking at the stock market, the bond markets every single day. They have lots of resources. Fidelity has way more research and way more resources than we're ever gonna have as ourselves. You can get a lot of diversification. You can avoid behavioral mistakes. A lot of people were calling us at the beginning of the year with these tariffs and say, we gotta get out, and that would have been a huge mistake. That would have been a behavioral mistake. Cost efficient to have a manager or a mutual fund or whatever to manage your portfolio for you. And the most important thing for a retiree is you save a lot of time so you can do other things.
Excuse me.
Yes.
So, I'm sorry if this is a dumb question. I know absolutely
There's no
nothing.
dumb questions.
I know nothing about this. That's why I'm asking, and I'm here. Is AI gonna start becoming a thing here with investments and computerization?
Potentially.
You guys seeing that right now?
We're seeing it help our business mostly.
In what way?
It saves us time, to analyze a tax form used to take a week or so. AI can do it in 15 minutes.
Yeah, so we take tax returns and run it through our AI software, and in 15 minutes, we get like a 10-page report that we can present to the client with all the key figures from their 100-page tax return. It's really cool.
It's very cool.
We just have to send to the back office, wait 2 weeks and get it back.
Because I saw it said avoiding behavioral mistakes. It's like, well, everybody swears by AI. It's like,
Yeah,
yeah,
so-
I would assume.
I don't know if
Right.
AI would avoid that unless you put it in a program that would stop you from selling. Whereas, a human being can say, hey, you're based on past crises or past things, you're making a mistake here. You shouldn't sell. I guess AI could do that too, but
Yeah.
you can override AI.
And they can
Sure.
also do like research and stuff for you as
Yeah.
well. But at the end of the day, it's gonna take the human to interpret
Of course.
and make the right behavioral choice.
Yeah.
Good question. As a
Good
first.
question.
Okay, professional managed investment vehicle. So how do you access professional investment management? This is page 36. You can buy a mutual fund. A mutual fund, you're hiring a mutual fund manager to buy and sell the individual stocks beneath the surface, right? So you're hiring the mutual fund to pick your stocks for you. You're not going out and picking your own individual stocks. You can buy an ETF or an exchange traded fund. Again, you're having the fund pick your investments as opposed to you picking your individual stocks and bonds. Unit investment trusts are pretty old school, so we're not going to go over that. Separately managed account, we'll go over here in a minute, but that's hiring an advisor to select your stocks or to select your ETFs and mutual funds, essentially. And then some annuities offer professional managed investments as well. So we're going to go through these by starting with a mutual fund. What haven't we talked about on mutual funds you want to talk about?
The mutual funds have different strategies. Not, one mutual fund isn't the be-all, end-all for everyone. There are value mutual funds, there are growth mutual funds, small cap, mid cap, large cap, international, fixed income, you name it, there's all kinds of different ones. Mutual funds trade at NAV or net asset value at the end of the day. If you were to sell or call your advisor or your broker or whoever to sell a mutual fund, let's say you call them in the morning, they're not going to actually sell that mutual fund until the end of the day. They could, they'll distribute, the securities inside there, any interest or dividends, they'll distribute to you. You can still, you can reinvest those dividends, and here's a question we get all the time. If I reinvest the dividends, do I have to pay taxes on them? The answer is yes. You still have to.
That depends on
Four-letter
whether
word,
you're invested in
5
a
letters.
qualified account or not.
It's right. If it's in an IRA, you don't have to. But anything coming out of an IRA or a qualified account is taxable.
So in a mutual fund, you're hiring a manager to pick the investments you're investing in, right? That team of managers beneath the surface, you're paying them to trade the different stocks based on the type of mutual fund that you have. So mutual funds, there's an underlying investment expense. It's the expense that goes to the Fidelity fund or the JP Morgan fund or whatever fund that you're investing in. There's an internal expense. And you're hoping that expense, that manager is adding value, right? They're doing a good job picking the stocks and bonds that you've asked them to do. Jay mentioned there's a wide variety of different types of mutual funds that you can choose from, anything you can possibly think of.
You gotta be careful with mutual funds because the expense ratio and the amount of securities inside some mutual funds can really drag down performance. As a matter of fact, with stock mutual funds, 80% of the mutual funds don't actually outperform the index that you're hiring them to perform. It's kind of sad, and a lot of people don't understand that if you're looking for a growth investor and you buy, I don't know, whatever growth fund out there, you got an 80% chance that manager's not even gonna beat the S&P 500. So you might wanna be just in the S&P 500. You pay lower fee, you have some tax advantages, and you probably beat the index. It's just the opposite in bond funds. If you go into bonds, the index is always actually even greater than 80%, it's almost like 90% of the time. The index will underperform most money managers. This is just the opposite. And the reason there is because if you're buying an index like the Barclays Aggregate Index, which is all the different types of bonds from 0 to 30 years, and interest rates start going up, well, the bond fund manager is not going to buy 30-year bonds at 3% or 2%. The index has to. So that's why they kind of underperform. So be careful there.
Exchange traded funds in the last 15, 20 years have become extremely popular.
Way popular.
Yes. A couple real big reasons for that. One is they're super inexpensive. There is not I said earlier, the mutual fund, you're hiring a manager to pick the stocks beneath the surface. The ETF, there's not a manager that does it. It's kind of computer based. Okay? But you're selecting, so you might buy an ETF that is just the S&P 500. So you turn on the news and see that the S&P 500 is up 1%. You're up 1%. It just follows the S&P 500. You could get an ETF that just follows, I don't know, India. You could follow their exchange. So you literally are just following exchanges for the most part. So because of that, the internal expense is really, really small. There's some ETFs that are actually free. It's Schwab that has free ETFs.
JP Morgan too.
JP Morgan has free ETFs, so there's no internal expense. Because the computer's running it, and they make money in other ways by you investing in their ETFs. But ETFs are real handy in some markets. So in large growth companies, ETFs typically outperform the mutual funds. Because everyone knows the large growth names, Apple, Google. So that manager in the mutual fund that you're paying 1% is not going to outperform the ETF. But other places like international investments or small stock investments, having the mutual fund instead of the ETF makes a lot of sense because there's expertise in picking small companies or international companies that the mutual fund manager can add. Question?
Okay, Vanguard, for our 403B, my district, so, they have a predetermined.
Target
This-
funds?
Yes, exactly. So I'm asking the question, is that what this is? Because, no?
No.
Okay.
Those So that's a mutual fund,
Okay,
and mutual fund is set up to, mature or get more conservative the year you retire,
okay.
or near the year you retire.
2020, okay.
Yes, exactly.
Yeah.
I see the term on the same day. Is this some sort of day trading?
So mutual fund, you can, if you sold the mutual fund, it's not sold until the end of the day. The ETF, if you woke up at 9:30 in the morning and you wanted to sell the S&P 500 ETF, you can sell it. It will be sold at 9:30 in the morning. So you can get out at any time during the trading day. Versus a mutual fund, you cannot. Yeah.
Are there dividends with ETFs?
Yes. So the other big advantage is that there's no phantom capital gains. We talked about mutual funds and non-retirement accounts last week, paying capital gains each year, even though you didn't sell it, because they're selling beneath the surface. That's not the case with ETFs. The only taxes you pay on ETFs are the earnings that you actually earned.
Or if you sold it.
Yeah, when you sell it. Yeah. So in non-retirement accounts, we invest heavily in ETFs. In retirement accounts, we use a mix of mutual funds and ETFs. If we're not using individual stocks, that is. But in terms of a lot more money these days are going into ETFs than mutual funds. So we see really a changing of the guard where ETFs are becoming much more popular than mutual funds, for investors.
And then, again, a lot of the reasons are it's low cost, it's efficient, tax efficient, and a lot of mutual fund managers don't beat their indexes.
So you guys are sweating now.
Not us.
Well, not
Oh,
us.
wow.
Mutual fund managers.
Well,
are.
yeah, right.
Not you guys.
This is what we do. We do separately managed accounts. So we build portfolios for clients. In those portfolios can have individual stocks, individual bonds, mutual funds, ETFs, etc.
Combination of all of them, yeah.
Combination of all, one or the other, depending on risk tolerance, goals, etc.
Yeah. There's some usually higher minimums with separately managed accounts. It's usually 100,000, but there's some out there that go less than that. To Matt's point, we construct a portfolio for you and actively manage it as well, so you can be retired. You only pay taxes on capital gains that you incur. That's pretty much it.
That's about it. Questions before we shift gears to annuities? Yes.
So all the years I've been working, just have it taken out, put it in 401ks, 403bs, 457, different companies from different jobs. So different Fidelity or Lincoln or Valak or all these different companies and different kinds of funds. I have no idea where they put all the money and everything. Do you know what I'm saying? It's
Yeah.
like, now I'm like,
So you need someone.
I
to
don't
help.
know.
Yeah, you need someone to help you, especially since you're gonna retire.
Yeah, you want to bring it all together, see how you invest it, make sure.
And we're gonna show you some things.